Dave, my goodness, you can't even write this stuff in the storybooks. New stuff is happening every day. So if you are not paying attention to it, I think we could get in trouble. Today, we're going to be talking about credit tightening. As you guys know, that I live in Canada, but Canada and the United States are like cousins. We're the largest trading partners. In the United States, it's the world reserve currency. Canada sends almost all of its goods to the United States. We need to work together. That's why I'm always talking about both countries, and that's what we're going to be talking about today. So, when we're going to take a look at what is happening today, I just need to remind you of the meeting that we had with Jerome Powell earlier in the week. If you want to take a look at that, listen to what he says about credit tightening. Please listen for those words.
In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to.
Did you hear the potential headwinds of credit tightening? Now, the majority of people are just going to bull past that and not pay any attention to that because they don't actually know what that means and how it impacts them in their regular everyday life. I'm going to cut to the end of the story now and just tell you that means much higher interest rates. Let me explain, because I know that in Canada we had a pause. We also had a pause in the United States. But guys, when there's a pause, there's a difference between an advertised rate and the rate that is specially designed for you. That's what we're going to be talking about today, because we're seeing this all over with clients every single day getting shocked about the rates that are increasing. So this is the news that came out of Canada today. So for those of you who don't know, there is basically a monopoly on banks. There's only like 5 or 6 of them in Canada. They have the majority of the business. Okay. So these big banks are all governed by this government institution called OSFI, Office of the Superintendent of Financial Institutions. So this is what all the fuss is today. This 3.5% total weighted risk assets. So you and I know, what the hell does that mean? Okay. Because unless you heard of this before, I can tell you right away that you probably have never heard of it, and it doesn't actually mean anything when you hear that. But let me give you the nuts and bolts. What it means is a rainy day fund, just in case something goes funky. Imagine you went and talked to your boss, and the boss is telling you right now that you may lose your job. You're going to get a little bit panicky about it, and you're going to save up some cash for that rainy day. This is what the banks are being told, that for every $1 million, say, of a mortgage, you have to have 3.5% tucked away in the side in a separate account. 3.5% on $1 million is $35,000. Now you multiply that over tens of millions, hundreds of millions of mortgages, $35,000 at a time. You're now stuck with stockpiles of tens of billions of dollars that got nowhere to go because you can't lend them out. You have to have them sitting there in case stuff goes down. So why would the government actually be doing something like that? They're telling us right now that because they are worried about problems that are coming in the future. So what is this credit tightening? And when we look at Milton Friedman, he was an economist in the past. But he was a phenomenal economist. But he always says the primary problem is most people acknowledge and accept that interest rates is the price of credit. This is what we're always looking at. What is the credit interest? What is the credit interest? But nobody pays attention to the volume of credit, how important credit is to build businesses and build people. And this comes down to the crux of the entire issue, is we now have to put tens of billions of dollars aside for bad loans that may come due. And now there isn't any money to lend out. So now they call that a credit tightening, credit crunch. Really depends how you want to define that. But let's look at this website, Investopedia. Very, very, very important. Guys, please stick with me with this. What is a credit crunch? A credit crunch refers to a decline in lending activity. A decline in lending activity. You cannot get a mortgage. You cannot get a loan for your business by financial institutions brought on by a sudden shortage of funds. Do you think maybe having to increase a domestic stability buffer could do that? So this is Canada and the United States. Often an extension of a recession, a credit crunch makes it nearly impossible for companies or people to borrow because lenders are scared bankruptcies or defaults. Let's continue. Understanding a credit crunch. A credit crunch is an economic condition in which investment capital is hard to secure. You can't get a mortgage. Does that sound familiar? I mean, this is what's happening to all of our clients today. They can't get a mortgage. Banks and other traditional financial institutions become wary of lending funds to individuals or corporations as they are afraid that the borrowers will default. And here comes the pain in the butt. This causes interest rates to rise as a way to compensate the lender for taking on this risk. Could be called a credit squeeze, credit crisis. And how does this happen, you might say? How does this happen? I think this is important. A credit crunch often follows a period in which lenders are overly lenient in offering credit. Oh my goodness. Does this sound like 2020 and 2021 to you, when they were just so eager to lend out cash to anybody who had a heartbeat? So could this be because they lent out so much money? Yeah. The fallout from such a crisis can cause a pendulum to swing in the opposite direction. And notice here, banks curtail lending activity and seek out borrowers with pristine credit who present the lowest possible risk. Such behavior is known as flight to quality, which is exactly what we are talking about here. Last year, you may have got a loan, but this year, you don't necessarily get a loan. You can't get a loan for your business. You can't get a loan for your mortgages. And this is going to be the largest pain that is going to be coming on people, bar none. You think that going from 0% to 5% is a bad thing? You guys, let me tell you, I made a video of this a couple days ago. Interest rates going from 0 to 5 is nothing compared to you can't get a mortgage. No way, no how. No banks. We just had a client. I told it about it on another video. 12.9% he had to pay and 2% loan origination fee. So the problems are real and the problems are going to continue, unfortunately. So this credit crunch is going to continue on. Now, how big is it? Well, Canada's big banks log a 13-fold rise in loan loss provisions. Why do you think that the banks now are doing this? Why do you think the banks are putting so many billions of dollars aside? Canada's top 5 banks put aside these loan losses since 2020. Right now, in one quarter of 2023, the first 3 months, they were putting over $1 billion per month aside. Imagine the United States is 10x that. All of the big Canadian banks singled out elevated risks in North America's commercial real estate and why they keep on adding it to. Just check our history. We have videos on commercial real estate where we're afraid of it as well. If we want to branch out from that, let's take a look at the Office of the Superintendent of Financial Institutions. It's a mouthful, OSFI. These guys are the ones, and they're trying to tell you why they decided to raise this up. Why do you think that they want you to put even more money aside? Their rationale: that they assess vulnerabilities remain elevated and rising. Highly indebted households and corporates more vulnerable to shocks. And principal payments have declined. People are not paying down their properties. They could barely keep up with the interest. And notice this, 12% of uninsured mortgage borrowers are only covering interest payments or are negatively amortizing impacts. So hang on a second. We need to understand that if you were telling me that 12% of people are not paying their mortgages, they're adding to the length of time that it is. So we have one client, 101 years is how long it's going to take them to pay off that mortgage. 101 years. Are we understanding how bad that is? 12%. Please remember that all the nightmare that you saw in 2008 and 2009 was a result of 4.5% of United States had problems with their mortgages. They went into foreclosure. 4.5. And you're telling me already we're at 12% and we haven't seen anything. Home prices are still going up. We have to be grown up and have an honest conversation with ourselves and say, there is a problem here. So it says housing prices have begun to rise again in recent months as the supply of new listings and inventory remain near historical lows. That is one part of it, right? One part. But the other part that we're talking about is these extended amortizations where we're letting people pay off their homes in 70, 80, 90-year amortizations. That's cuckoo. And that's a big problem, right? And that's the majority of why inventory is so low. Why would anyone ever sell if they were locked into a 2% mortgage, or they could get an 80-year mortgage? I mean, why not? But there's problems that will come from that. At the end, we'll cover that in a bit. The risk environment is expected to be characterized by heightened uncertainty as the effects of higher interest rates take hold. Now, of course, we cannot tell you exactly the day that this is going to happen. I don't know the exact day, the exact moment, but I can tell you forever, for as long as math has existed and mortgages have existed, home price plus interest rate has to equal your salary. That's it. You have to be able to pay off your loan. And so this is tale as old as time. If interest rates go up, we're going to see an effect in the prices. It takes time, though. Like you guys know, I'm always talking about the lag effect. It's 18 months for it to actually take effect after the rate hike. We have not even seen 18 months after the first rate hike, let alone the other 9. We got to wait. And we're going to see this happen over time. But this is why I'm trying to help people, educate people, because I don't want people to get hurt. So if we continue on, what is negative amortizations? This is what they were referring to. And I pulled up an example for you to take a look at. Imagine in month 1, the first installment here, you have a $300,000 loan. I know this is hilarious because no home in Toronto, where we are, is even close to that. Most people are over $1 million. But notice that the payment is $2,000, but the interest on that loan is $3,000. Can you see that? You're $1,000 short. So what they do is they add the $1,000 to the closing principal. At the beginning of the month, you owed $300,000, and at the end of the month, you owe $301,000. At the end of month 2, you now have to pay interest on $301,000. Now you have a $2,000 payment. You have $3,010 worth of interest. So now they just have to stack it on to the end. And if you just take a look at the end during a 1 year, it's going up and up and up and up every single month. Now in Toronto, where I am, this is probably triple that. So imagine your interest going up, your property mortgage going up $100,000 a year, because that's what we're seeing today. This is a big problem. So if we go and look at the United States has high inflation. Canada is having high inflation. But if we take a look at the consumer price index in the United States right now, you could see where it has a section for shelter right here. And if we look at year over year, it's at 8%. Rent up 8.7%. Very, very high. It is skyrocketing. Okay. Why is my question to you? Why is shelter going so high? If you take your house price and you add a ton of interest, now it's costing the landlord a huge amount of money in order to have that property. He's losing big. So if he can raise the rent, he's going to try to cover his cost, and he should. And now rents are skyrocketing because interest rates have gone up. Now that the rents are up, it measures as high inflation. So then they have to raise up the interest rate again. Do you notice this doom loop, this doom spiral that we're on? Again, you've raised the interest rates up, so rent has to go up, which now reflects in high inflation. And when they see high inflation, they have to raise interest rates again. You have to understand that circle doesn't stop. It's this very bad doom loop that we're stuck in. Okay, that's the United States. Let's take a look at Canada. In Canada, mortgage interest costs rise as homeowners' replacement costs slows. So shelter costs rose 4.9% on a year after a 5.4% increase in March. But Canadians are continuing to pay more in mortgage interest costs, 28%. If we remember in that speech, the government was mentioning, the Canadian government, they are expecting mortgage payments to go up 40%, 40. That is massive. This is going to cause huge inflation in Canada. But in response to the high interest rates, now we have high inflation. High inflation is going to give us even more interest rate hikes. But remember what I said, the high interest is not the main problem. The problem is having no credit whatsoever. So let's jump into another chart that I wanted to share with you guys that I prepared. Just hang on one second. Let me share my screen with my my fun writing here. Okay, so we're looking at this domestic stability buffer, which started this whole thing off right now. The domestic stability buffer is the one that is putting cash aside in case something was going to go down. Okay, so we would do this. We would call it a rainy day fund if it was me or you trying to save some money. So if we take a look at this, okay, domestic stability buffer in 2019, it was at 2.25%. Can you see that right there? 2.25%. This is before all the lockdowns and so forth. But then something crazy happened. Absolutely bananas. At the same time as interest rates went down, when interest rates go down, remember, normally credit is very tight. We actually had very, very loose money. Anybody with a heartbeat was getting money because the government was backing it up. So they only required 1% down, which actually caused everybody to dive into the market. The banks were willing to lend out money like crazy. So if we look at 2022, they had to raise it up to 3% as we saw that inflation coming in to kick everybody's butt. Please remember, back in 2020, the legal limit was only 2%. Now the legal limit is 4%. They've had to up it. So in 2023 now, they've upped it to 3.5%. So what I was saying to you before was on a $1 million mortgage, they used to only have to have $10,000 in cash put aside for a rainy day fund, 1%. Now they have to have $35,000 put aside in case you have some big problems. Isn't that crazy? That it's 35 grand now. Now you multiply that by everybody, we're talking billions of dollars. And here comes the Milton Friedman that we talked about before. Low money and cheap money is normally very, very tight money. So how can we explain this in an easy way? Just imagine this is the one tool that the governments actually have, one tool that they can raise or lower interest rates. So you got to tell me, when do they actually lower interest rates? When can you think of it? They lower interest rates when things are dodgy, very, very dodgy. And so if something is really, really rough in the economy right now, and we're running into trouble, the economy will drop those interest rates, and that's the advertised rate. Who gets that advertised rate? Normally, only the AAA best Jamie Dimons of the world get 1%, whatever is the advertised rate. You and I know they want to know our incomes, how much debt we have, and every other possible thing. They have to do a whole audit on us, right? And then they're going to adjust their rate up based on who you are. So normally when you're in a recession and they lower rates, that advertised rate is only for the big institutional buyers and not for regular people like me and you. 2020 and 2021 is this weird time in history that this same time of having low rates, we also were giving money away to everybody, in most cases for free. And so everybody kind of remembers that that's the last thing that happened, but they don't remember every other recession in history. This is the part that is coming to bite people in the butt right now. Remember what Milton Friedman said, everyone's looking at the rate, but no one's looking at the credit volume, the amount of people that can get mortgages, or the amount of people that can get loans in their business. What you're seeing today is that the majority of people cannot, and they're not refinancing at the rates that they were before. Let's jump back into this because we gotta continue on with this because I got more stuff for you. So we're keep on bouncing back to what we had talked about before. We were talking about Milton Friedman, that low money, okay, or cheap money when it's at 1% does not mean that everyone can get it. Very tight conditions for people who can get money. Now, the reason that they're adding to this buffer and all of this savings from the governments and people are putting money aside is because housing. Here comes the part that's going to bankrupt a lot of people. The advertised rate today might be something like 5.5%. And when you walk into your Bank of America or TD Bank and they offer you 10%, you are going to have a coronary. You're going to absolutely freak out and say, I cannot live like this. Why on earth am I getting a 10%? Their answer to you is going to be, we only lend to AAA people. That's going to be the answer. And then the next thing I know you're going to say is, well, guys, I am a AAA client. Last year in 2022, I had a credit score of 700 and I made 40 times my mortgage payment per year. So if your mortgage payment, just let's say, is 1,000 and you made $40,000 a year, that would be 40x your mortgage payment. And so you had very low debt, a couple credit cards, a small line of credit. Okay. And they said last year you were AAA. Here comes your problem, because you had the understanding that AAA or AAA always meant the same thing. Let's move forward till 2023 and then look at what it is here. In 2023, they now want, for AAA, their category, they've changed the definitions. Now they want a credit score of 800, not 700 like you had the year before. Last year, they wanted you to make 40 times your mortgage payment per year. Guess what they want now? Now they want 100 times your mortgage payment. Last year, they were willing to accept low debt. This year, they may want no debt whatsoever. Their criteria for AAA people have changed. And so when you have changed in their risk rating, you no longer get the advertised rate of 5.5. You are going to be offered something much higher. What we're hearing today, we're hearing a lot of 8s and 9s is what we're hearing right now. So if you see this, don't be surprised by it and try to shop around and try to lower whatever debts that you can right away. So you're going to tell me right now then, how on earth, David, are people affording this? And this is what we were talking about the long tail of this negative amortization that is happening. So this negative amortization that is happening, let's take a look at this. So just let's say that you had a loan, for example, and you started it in 2020. I'm putting the year here. Do you see this big black line where you're starting? Okay. And you started off at a $3,000 payment per month. Okay. $3,000. Now, as this interest rate has been changing over time, this mortgage payment is going up and up and up and up. And currently it's sitting at $5,000 up here, way up, way over what you can afford here in 2023. Here is your problem. If you can't afford $5,000, you can go to your bank and go, Mr. Bank, I can only afford $3,000. So I want you to tack on that extra $2,000 that I'm missing every month to the end of my mortgage. Well, David, is that even possible? Is that legal? Are you allowed to do that? The answer is absolutely you're allowed to do that. The banks are allowed to do that. And the worst that I have seen right now is 101 years that has been pushed out. So I don't even understand that. It's not even you. It's not your kids. It's your grandkids that are going to pay off the house. How crazy is that? But wait, 101, they take the total payment that you owe and divide it by what your monthly payment is. That's how they come out to 101 years. But David, I thought you said that you're not allowed to have a mortgage over 25 years, and you are correct. The question is when. So if we take a look at this chart again and pay attention to these couple lines. In 2020, when they started this loan over here, they had it set up till 2025. And so the law says that you can only have a 25-year amortization, number one, when you either start your mortgage or when you renew. So this guy now, who's supposed to be paying $5,000 a month, who's only paying $3,000 all the way down here, is riding it out until this brick wall that is coming to him in 2025. Because in 2025, they're not just going to ask him, well, you were paying $3,000, you were supposed to pay $5,000. Now, what about all of this extra debt that he added on to himself over the years? And this is going to continue right on. When he comes to refinance that at the end of 2025, he now is going to have a payment of like $7,000 per month because it has to, by law, snap back to 25-year amortizations. Are you understanding the seriousness of that? We now are at 12%, according to their numbers. 12% of people are in this situation, and they are like a train riding down the tracks toward a brick wall, knowing that their payments are going to go from $3,000 to $7,000. One of our clients, their payments is going to go from $3,000 to $12,000. So what would you do in that situation? The majority of the time, I'm telling them, you got to sell your property. And I know that I sound like a broken record because I was telling you to sell your property last fall. Who on earth would have known that Silicon Valley Bank would have collapsed and they would have lowered their commissions and that would have bumped up home prices? Crazy. So you should be taking this whole up in prices that we've seen as manna from heaven, as an amazing, amazing gift. On average, where I live, the property prices are up $150,000. This is not just about Toronto. This is not just about Canada. This is all over the United States as well. Crazy. So to me, you got to be taking some cash off the table. So let's see, how do we see that Canadians are faring right now? How do we think that Canadians are doing? How do we think Americans are doing right now? They are our cousins, right? We have to follow these guys and see what they're doing. So let's take a quick check and see where we're in. So in United States in 2023, where we are right now, average credit card debt per adult, $3,900. Notice that we're at an all-time high. Notice that credit card usage in the United States is way up, $1 trillion right now. $1 trillion in credit card debt alone. So how is the savings? People must have cash left over, right? From the last, all the checks that were sent out, et cetera, et cetera. Please note that the savings in people's accounts are at record lows. It hasn't been this low since I don't even know what. What does that show you? Oh, since back in 2009. Oh, during the last recession? That's how low their savings is. How is Canada faring, you guys? If you see Canada, this is Canada's household savings rate. As you saw, it spiked up during COVID when nobody could go to any restaurants or anything. But look at the crash. There is nothing in history since 1950 that has crashed as fast as this has, and the cost of living biting on Canadians. We are coming up on a record low in savings rates that we have not seen. That is terrible for Canada. How is Canada's consumer credit? Well, this chart goes back until what I would presume in mid 60s or 70s, and we're at record highs right now. So if we take a look at the federal rate, you guys, this is the federal rate. Every time there's a pause at the top, these gray lines are a recession. Every time there's a pause at the top, we're in a recession. There's a pause at the top, recession. Pause at the top, recession. Pause, recession. Pause, recession. Guys, I am not a financial advisor, and I'm not here to tell you what to do, but I am here to try to help you. That's what I'm here to do. We have to put some things together. United States is one of the most largest and most important economies in the world, and the world reserve currency. Canada is tied to the hip to the United States, period. Everything that we do is for them. So if we're seeing across the board, Canada and United States, 400 million people that all have record low savings rates, record high credit card usage, and a tsunami of debt that is rolling over in the commercial real estate and the residential real estate. It's not that nobody is paying attention to it. Look at what the banks are having to do now. The banks are having to stash more and more and more cash aside for loan losses, United States and Canada. Over $1 billion a month in Canada, over $10 billion a month in the United States, aside for mega losses. In addition, the domestic stability buffer has to go up, mandating more and more cash aside for the losses. What are they seeing that maybe I'm not seeing, or maybe you're not seeing? The main goal of this channel is not to scare you guys, but to educate you, and hopefully just to spur on a little bit of curiosity for you to dig a little bit deeper to try and find the answers. Maybe, just maybe, one person is going to see this, dig a little bit deeper, and not be in the trouble. Listen, you guys know that I'm a real estate broker and I specialize in selling properties. Yes, and I and my entire team, this is what we specialize in. We're very good at it. most agents, most real estate agents always out there are going to be telling you the market's always going up. It's always going up. Markets never go down. It's about the time that you're in the market, and the majority of the time they're right. But in an instance now where a lot of people will have had a mortgage that is at 1%, we had some clients at 0.99, and now they're facing a 10% interest rate. The amount of damage is ridiculous. We have an entire population in addition to that that is younger than me, the YOLO generation, that this one comment came on there and said, interest rates, schminterest rates. Who cares? Home prices only go up. This goes to show you a little bit about how little knowledge that some people have about how interest rates affect it. You need to have the income to pay for it. That's the problem that we're having right now. In Canada, only like the top 5% of people can afford to buy a home with the rates the way they are today. So hopefully this helps you guys out a lot. I think it does. I think it would. So if you like this stuff, please like this channel. Please follow it. Please hit that notification bell. And like always, we try to come on here and help you guys out. But, you know, these payments are going to continue to go up, and it's not going to go down, unfortunately. So please, please, please be safe out there. I'm here for you as much as I can. Please like and follow, and I'll talk to you soon on the next